Imagine for a moment a huge global corporation, right? Operations spanning continents, pulling in billions, and their main focus, legally slashing their tax bill, maybe even getting close to zero in some major countries. How on earth do they even attempt that? And what does the U.S. tax system do about these really complex strategies? Well, today we're pulling back the curtain on this high stakes world of international tax. It's a place where billions are always in play, and for every rule, there's like a counter rule. Welcome to the deep dive. You've given us a pile of sources on international tax issues. Now, this might sound dense, maybe even a bit dry at first, but trust us, once you start understanding the core strategies, this dance between multinational companies and tax authorities, it's actually fascinating. Our mission today, to pull out the most important nuggets of knowledge, give you a shortcut to understanding how these global businesses handle taxes, and crucially, how governments try to keep things fair. We'll look at the tax-saving methods companies use, but also how laws try to stop them going too far. It's really an invaluable peek into global finance.
So what are we actually getting into? We'll unpack concepts like transfer pricing, that's how related companies price goods and services between themselves. It's key to where profits land. We'll explore the big differences tax-wise between running a foreign operation as a branch versus a separate subsidiary. It's a huge strategic choice. Then we'll tackle the really critical U.S. anti-deferral rules, things like Subpart F and GILTI. These are designed to tax certain foreign income right away, pushing back against deferral. But it's not all about stopping avoidance. We'll also look at legitimate tax benefits, ways to avoid double taxation, like foreign tax credits, and this thing called the foreign-derived intangible income deduction. Ultimately, you'll get hopefully a really nuanced feel for this delicate balance between encouraging global business and making sure taxes get collected fairly. It's like a global chess match, honestly, and you're about to get a front row seat.
Okay, let's start with the opening move, maybe the offensive strategy in this chess game. How big companies, these affiliated groups across countries, try to minimize their income taxes globally.
The basic idea really is to manage internal sales between their own subsidiaries. Make income look lower in high-tax countries and shift it somewhere with lower taxes. It's about finding the path of least resistance, tax-wise.
Exactly. It sounds complicated, but the logic is pretty straightforward. Put the profits where the tax rate is lowest. Let's picture a U.S. holding company, okay? It owns 3 subsidiaries. M company makes things in country M, where the tax is just 10%. W company is a wholesaler in country W, tax rate 20%. And our company is the retailer, right here in the U.S., facing a 30% rate. They all deal in widgets. M company makes them for $1 each. Our company sells them to the final customer for $9.
Right, so the total profit for the whole group on one widget is $8.
Yeah.
Now, if we just ignore the IRS rules for a second, the very rules meant to stop this, how would the holding company want to price things internally to pay the least tax on that $8?
Well, the dream scenario for them would be M company sells the widget to W company for $9. Then W sells it to R for $9. And R sells it to the customer for $9.
Ah, I see. So M makes it for $1, sells it for $9. All the profit happens right there.
Precisely. In that setup, the entire $8 profit per widget, the $9 final price minus the $1 cost, gets reported only by M company. And M company is in country M with that super low 10% tax rate. So the group pays just $0.80 in tax globally on that $8 profit. And it all goes to country M. Meanwhile, country W gets nothing. And the U.S. gets nothing in income tax, even though the final sale happened here.
Okay, so country M is happy collecting all that tax. But yeah, the IRS and country W's tax people, definitely not pleased. They got zero, even though value was added or the sale occurred in their territory. This really highlights the core problem, doesn't it? How do countries get their fair share when profits can just be, invoiced across borders?
Absolutely. And that's exactly where international tax rules, especially transfer pricing regulations, come into play. It's the government's countermove. The IRS's main weapon here is found in the Internal Revenue Code, specifically sections 482 and 6662Q3. These give the IRS really broad power. They can adjust income, deductions, credits, even the cost of goods sold between related companies. The goal is clear. Stop tax evasion, sure, but more broadly, make sure income is reported accurately where the economic activity actually happens. And they can slap on pretty big penalties if you don't follow the rules. That's a big stick.
So back to our widget example. M sells to W at $9. W sells to R at $9. The IRS looks at our company in the U.S. and says, what?
They'd likely say, hold on, our company, your cost for that widget is $9, and you sell it for $9. Would you really pay $9 if you were buying from a totally unrelated supplier?
No way.
Yeah.
An independent retailer needs to make some profit.
Exactly. So the IRS would almost certainly argue that our company's cost of goods sold is too high. They'd reduce it, which forces our company, the U.S. entity, to recognize profit. And once our company recognizes profit, it has to pay U.S. income tax on it. That's the arm's length standard in action.
The arm's length standard. That sounds like the core principle here.
It absolutely is. It's the foundation of transfer pricing globally. It basically says transactions between related companies, controlled transactions, have to produce results similar to what unrelated parties would achieve in the same situation. It forces these internal prices to reflect market rates, not just, internal tax saving schemes. It's about making related companies act like they're dealing at arm's length, like strangers in the market.
That's quite a concept, forcing integrated companies to pretend they're independent. So just to clarify, a controlled taxpayer is basically any two or more businesses owned or controlled by the same people or interests.
Right. And control is read very broadly: direct, indirect, legally enforceable or not. Even just acting together. If income seems shifted arbitrarily, control is presumed. A controlled transaction is just any deal between these related parties.
And the opposite, uncontrolled taxpayers or uncontrolled transactions, those are the benchmarks, the deals between unrelated companies.
Exactly. Those are the reference points. And an uncontrolled comparable is a specific unrelated deal used to figure out the arm's length price for the controlled transaction.
And this IRS power under Section 482, you said it's broad.
Incredibly broad. They can distribute, apportion, or allocate income, deductions, credits, allowances, you name it, among related businesses. It applies whether they're U.S. or foreign, incorporated or not, even if they file a consolidated U.S. tax return. And crucially, it's not just for fraud. The IRS can step in if the company's taxable income is simply other than what it would have been if dealing at arm's length.
Which brings up the tricky part. How does a company prove they met this arm's length standard, especially when dealing with their own subsidiary?
That's the million-dollar question, or often billion-dollar question. Since identical transactions between unrelated parties are super rare, you usually determine the arm's length result using specific methods based on comparable transactions. The Treasury regulations outline several acceptable pricing methods. There's the comparable uncontrolled price, CUP method, mostly for tangible goods, often using market data. Then the comparable uncontrolled transaction CT method, that's for intangibles like royalties, you look at similar licensing deals. You also have the resale price method and the cost plus method, common for tangible property distribution and manufacturing. And finally, the comparable profits method, which looks at profitability metrics, margins, return on assets of similar independent companies.
So they have a whole menu of methods to choose from, and the IRS can do more than just adjust income.
Oh yeah, they can change the tax basis of assets or even force income recognition on transactions that would normally be tax-free, like certain incorporations or property swaps. They have a lot of tools.
And the company has to prove its pricing was right.
Generally, yes, the burden is on the taxpayer. Though courts can overturn an IRS adjustment if the company shows its results were within an arm's length range, usually based on analyzing several comparable uncontrolled transactions. It's also worth noting, a company can make these adjustments itself on its original timely filed tax return to reflect arm's length pricing. But they can't use this later on an amended return just to lower their tax bill.
Okay, so avoiding penalties. That sounds important. How do companies protect themselves from these substantial or gross valuation misstatement penalties?
It really boils down to documentation. Proactive, detailed documentation. They need to prepare what's called a Section 482 study. The study has to use one of those allowable pricing methods, show the pricing was consistent with it, and argue that the method was reasonably applied. And critically, this study must be done by the time they file their tax return.
Must be done by the filing date. That's a hard deadline.
Absolutely. There's an alternative if no standard method works, but you have to prove that and document your different method, again, by the filing date. Penalties might also be avoided if the transaction is purely between two foreign subsidiaries unless it impacts U.S. source income or a U.S. business somehow.
What if an IRS adjustment leads to double tax? Like the U.S. taxes the income, and the foreign country also taxes the same income.
That's a major concern. In that situation, the taxpayer can request competent authority assistance. This is usually part of a tax treaty. Essentially, the IRS and the foreign tax authority talk to each other to try and agree on the correct transfer price and eliminate the double taxation. It's a sort of diplomatic resolution process.
Sounds like it could take a while, though. Years, maybe? Is there a faster, more proactive way?
Yes, thankfully. There's the Advanced Pricing and Mutual Agreement Program, or APMA. This used to be called the APA program. Its whole purpose is to resolve potential transfer pricing fights before they even start, cooperatively and upfront. The company and the IRS basically agree ahead of time on the method, the comparables, the years it covers, any adjustments needed, the acceptable price range, and critical assumptions about the business.
So they negotiate a deal beforehand.
Pretty much. It often involves some give and take. The IRS might agree to the company's view on one point if the company concedes another. It shows a pragmatic approach to these really complex issues. It offers certainty, which is hugely valuable.
So wrapping this part up, what's the key takeaway for our listener? This whole arm's length thing, it's like a legal requirement for companies to act like they're independent, even within their own group.
Right. It forces them to constantly justify their internal pricing. Every intercompany deal, big or small, becomes a potential tax issue.
It seems less about sneaky tax evasion and more about interpreting these super complex rules and agreeing on where profits should be taxed globally.
Exactly. It's a negotiation about allocating the global profit pie among different countries. It's not about hiding money. It's about determining where income is legally considered earned for tax purposes. And that determination can have massive financial consequences.
Okay, moving beyond just pricing. Another huge decision for U.S. companies going global is how they set up shop overseas. Do they use a foreign branch or create a whole separate foreign subsidiary? This choice has massive U.S. tax effects. But even before that, they need to figure out if they even have a taxable presence abroad. That brings up permanent establishment, right?
That's the starting point, yes. When a company makes money in another country, permanent establishment, or PE, determines if they actually have a taxable presence there according to tax treaties. Traditionally, it meant having a fixed place of business, like an office or factory, and operating through it regularly. So a foreign branch or subsidiary usually creates PE.
But things are changing, aren't they? Especially with digital businesses.
Absolutely. The concept is really being stretched. Now, PE might include having a virtual economic presence, even without a physical office. Think about online services, massive data centers. The exact rules depend heavily on the specific tax treaty between the countries, or if there even is one. But finding out if and where you have PE is step one. It tells you where you might owe foreign tax.
Okay, so once you know you have a taxable presence, then comes the choice,
Mm-hmm.
branch or subsidiary. How does that impact U.S. taxes?
It has huge U.S. tax implications. Let's start with the foreign branch. Legally, it's just an extension of the U.S. company, not a separate entity. Because of that, its profits and losses are treated as earned directly by the U.S. parent company. They get taxed by the U.S. immediately when earned, even if the cash stays offshore.
Immediately taxed. But you mentioned a tax-saving aspect here, especially for startups.
Yes, that's the flip side. If the foreign branch incurs losses, those losses can immediately offset the U.S. parent's domestic income. This is a big plus in the early years when foreign ventures often lose money. The U.S. company also usually gets a foreign tax credit for taxes the branch pays overseas, though it's limited. And bringing profits back from a branch isn't usually another taxable event in the U.S. since they were taxed already, except maybe for currency fluctuations.
Any downsides to the branch structure?
Well, the foreign country might impose a branch profits tax. It's like a withholding tax on profits sent back to the U.S., kind of treating it like a dividend payment, even though it isn't one legally.
Okay, so that's the branch. What are the foreign subsidiary?
A foreign subsidiary is totally different. It's a separate legal entity incorporated under foreign law. Its income gets taxed by the host country first. But here's the key difference. U.S. tax on the subsidiary's earnings is generally deferred until those earnings are brought back to the U.S. parent, usually as a dividend.
Ah, deferral. That sounds like a major tax-saving method. Control over timing.
It absolutely is. It lets companies keep earnings offshore, reinvest them, grow the foreign business, all without triggering immediate U.S. tax. Huge advantage. But there are big catches. Certain types of passive income earned by the subsidiary don't get deferred. They get taxed by the U.S. right away under those anti-deferral rules we mentioned, like Subpart F. We'll get into those. And precisely because of this deferral potential, transfer pricing rules are super important for deals between the U.S. parent and the foreign sub. Got to prevent artificial profit shifting. Big penalties if you mess that up.
So, summarizing, branch gives you immediate loss, offset, maybe simpler repatriation. Subsidiary gives you deferral of income. Two very different strategic plays.
Exactly. Different tools for different situations and goals.
Right. So we know where we might be taxed, PE, and how we're structured, branch sub. What's next? Figuring out where the income actually came from. Sourcing rules.
Well, precisely. Sourcing rules are fundamental. They determine if income or deductions count as U.S. source or foreign source. This is crucial for everyone. For non-U.S. persons, it dictates what income the U.S. can even tax. For U.S. persons, it's essential for calculating the foreign tax credit limitation. You need to know your foreign source income.
The code lists specific rules for different income types, right? Maybe we can hit a few key ones.
Sure, let's take interest income. Where does that come from? Generally, it depends on the residence of the payer. So interest paid by a U.S. company is U.S. source. Interest paid by a foreign company is foreign source. Simple, but powerful for intercompany lending.
Okay, what about rent or royalties?
Rental income is sourced based on where the property is located. Rent from a U.S. building, U.S. source. Rent from a French building, foreign source. Doesn't matter where the tenant is. And royalties follow a similar logic. They're sourced based on where the intangible property, like a patent or copyright, is used. If it's used in the U.S., U.S. source royalty. Used in Germany, foreign source royalty.
Let's make this concrete. You mentioned M&E Corp. In the notes, a U.S. company with operations here and in France, they had various income streams.
Right. M&E Corp. Let's break down their income sourcing.
Yeah.
$5,000 dividend from B Corp, a U.S. company. Payer is U.S. That's $5,000 U.S. source. $10,000 interest from F Corp, a French subsidiary. Payer is foreign, so $10,000 foreign source. $17,000 interest from U Corp, a U.S. subsidiary. Payer is U.S., so $17,000 U.S. source.
Okay, payer's location for interest and dividends.
Yeah.
And now rentals and royalties.
$29,000 rent for property in South Carolina. Property location is U.S., so $29,000 U.S. source. $36,000 rent for property in Nice, France. Property location is foreign, so $36,000 foreign source. $43,000 royalty for a patent used in France. Place of use is foreign, so $43,000 foreign source.
Got it. So if we add that up for M&E Corp, U.S. source is $5K plus $17K plus $29K. That's $51,000.
Correct. And foreign source is $10K plus $36K plus $43K, which totals $89,000.
So what's the big picture here for you, the listener? These sourcing rules aren't just technical details. They are the absolute foundation for figuring out your international tax bill.
Every dollar has an origin story, a source. And that source dictates how and where it gets taxed. It directly feeds into things like the foreign tax credit calculation. It's step one in applying many international tax provisions.
Okay, now that we've got some of the basics structuring sourcing, let's zoom out a bit. How do countries like the U.S. actually approach taxing international income overall? There are fundamentally two big systems, worldwide and territorial.
Right. And the U.S. used to be pretty firmly in the worldwide camp before the big changes in 2017 with the Tax Cuts and Jobs Act, the TCJA. Under that old worldwide system, U.S. citizens and companies were basically taxed on all their income no matter where they earned it. The main relief valve was the foreign tax credit to avoid double taxation. Meanwhile, most other developed countries used a territorial system. They mainly tax income earned inside their borders, income earned outside, generally exempt from domestic tax. Their way of preventing double tax is usually a participation exemption or a dividends received deduction, basically. They just don't tax dividends coming in from foreign subsidiaries.
And the TCJA shifted the U.S. significantly towards that territorial model, at least for corporations, right?
It did. It introduced a 100% dividends received deduction, DRD, for certain dividends coming from foreign subsidiaries back to U.S. parent corporations. This was a huge change. It effectively exempts those foreign profits from U.S. tax when they're brought home as dividends. A major tax-saving mechanism intended to make U.S. companies more competitive and encourage repatriation.
Of course, non-citizens and non-residents are usually only taxed if they have a real connection, a nexus to the U.S., like income effectively tied to a U.S. business.
Exactly. The system treats residents and non-residents very differently.
Let's talk more about that foreign tax credit, the FTC.
Yeah.
Even with the shift to territorial,
Yeah.
it's still super important, right? It's a key tool for avoiding double tax.
Absolutely essential. Its whole purpose, under any system that taxes some foreign income, is to stop income being taxed twice, once abroad, once by the U.S. It's a critical tax-saving calculation for companies. The basic idea is simple. U.S. taxpayers get a dollar-for-dollar credit against their U.S. tax liability for income taxes paid to foreign governments.
But there's a catch, a limitation.
There is, and it's important. You can't use foreign tax credits to offset U.S. tax on your U.S. source income. The credit is limited. The formula is basically Your foreign source taxable income, your total taxable income, your U.S. tax liability on total income. So if your foreign tax rate is higher than your U.S. rate, you won't pay extra U.S. tax on that income, but your credit gets capped at the amount of U.S. tax you would have paid on that foreign income.
And unused credits.
You can generally carry them back 1 year and forward 10 years. But if you can't use them in that window, they expire. Lost savings.
And it gets even more complicated with these separate limitation categories or baskets.
Ugh, yes. To stop companies from, say, averaging high taxes from one country with low taxes from another, or using credits from active business income to shelter passive investment income, the FTC limit is calculated separately for different types of income. There are baskets for passive income, dividends, interest, etc., general active income, foreign branch income, and that GILTI income we mentioned earlier. It adds layers of complexity.
What counts as a foreign tax for the credit? Is it any tax paid abroad?
Not quite. It has to be an income tax or a tax paid in lieu of an income tax. Think taxes on wages, interest, dividends, royalties. Things like sales tax, VAT, property taxes, customs duties, those generally don't qualify for the credit. They might be deductible, but not creditable.
And companies can choose to deduct instead of credit. Why would they do that?
It's a strategic choice. If a company has U.S. losses or doesn't expect to have enough U.S. tax liability to actually use the credits within the carry-forward period, taking a deduction might provide a more immediate, certain benefit.
Okay, let's switch back to that territorial aspect. The participation exemption, or the dividends received deduction, DRD, that's the big tax saver under the new system for bringing profits home.
That's the centerpiece, yes. It allows U.S. corporations to potentially exempt foreign income entirely from U.S. tax when it comes back as a dividend, or take a deduction to offset it. Unlike the FTC, which just prevents double tax up to the U.S. rate, the DRD means for eligible dividends, there's no residual U.S. tax, even if the income was earned in a zero-tax foreign country.
And the TCJA made this a 100% DRD for U.S. corporations owning at least 10% of the foreign sum.
Correct. If you own 10% or more, you generally get a 100% deduction for the foreign source portion of dividends received. No U.S. tax on those repatriated profits. A massive incentive to bring cash home.
But surely there are conditions. You can't just use it on any income.
Definitely conditions. You can't claim foreign tax credits or deductions for taxes paid on dividends that get the 100% DRD, no double benefits. There's a minimum holding period for the stock. You have to own it for more than a year within roughly a 2-year window. And most importantly, certain types of income are specifically excluded from the 100% DRD. This includes income hit by the anti-deferral rules like Subpart F income, GILTI inclusions, earnings invested in U.S. property, and the income taxed under the one-time transition tax.
Ah, so the anti-deferral rules act as a backstop to the territorial system. They ensure certain mobile or passive income still faces U.S. tax.
Precisely. The DRD is for active business earnings generally. The anti-deferral rules target the income types Congress felt were most likely to be artificially shifted offshore simply to avoid tax. That leads us right into those rules. All right, let's dive into the U.S. anti-deferral regime. These are the rules designed specifically to stop companies from just parking profits offshore indefinitely to avoid U.S. tax. We're talking about outbound transactions, a U.S. person investing or doing business abroad, generating foreign source income.
And before the TCJA, the general rule was deferral, right? U.S. tax wasn't due until the money came home.
Mostly, yes. For active business income earned by a foreign subsidiary, U.S. tax could generally be deferred until repatriation, usually via dividend. This was a huge benefit, letting companies delay U.S. tax for years, sometimes forever if they kept reinvesting overseas.
But that created a big incentive problem. Companies just kept cash offshore.
Exactly. It encouraged shifting profits, especially mobile income, like from intellectual property to low-tax countries. Billions, even trillions, accumulated offshore, untaxed by the U.S. So the policy question became, how do you let U.S. companies compete globally but still ensure they pay some U.S. tax on foreign profits, preventing erosion of the U.S. tax base?
And the answer was these anti-deferral rules, forcing current taxation.
Right. The U.S. has two main regimes for this. The Passive Foreign Investment Company, PFIC rules, and the Controlled Foreign Corporation, CFC rules, often called the Subpart F regime.
Okay, PFIC first. What does that target?
PFIC rules go after foreign entities that look more like investment funds than active businesses. A foreign company is a PFIC if it meets either an income test 75% or more of its gross income is passive, like dividends, interest, rent, royalties, or an asset test, 50% or more of its assets are passive assets.
Yeah.
These rules hit U.S. shareholders, direct or indirect, even individuals. The tax rules for PFICs, like the Qualified Electing Fund, QEF, or mark-to-market options, are designed to eliminate the deferral benefit, often hitting you with interest charges for the period you deferred.
So PFIC is for passive investments. What about the CFC Subpart F rules? Are they broader?
Much broader and generally more impactful for operating multinationals. Subpart F dates back decades and was designed specifically to combat income shifting to tax havens, targeting what Congress considered bad income. First, the foreign company has to be a controlled foreign corporation, a CFC. That means U.S. shareholders own more than 50% of its stock by vote or value.
And a U.S. shareholder isn't just any American owner.
Right. For CFC purposes, a U.S. shareholder is a U.S. person, individual, or company who owns at least 10% of the foreign corporation's stock, again by vote or value. If the 50% ownership test is met by these 10% U.S. shareholders, it's a CFC.
What if a company is both a PFIC and a CFC?
Good question. If both sets of rules could apply, the Subpart F rules generally override the PFIC rules for those U.S. shareholders who own 10% or more. For instance, take ABC Corp. U.S. owning 12% of foreign D Corp. If D gets 80% of its income from passive investments, it's a PFIC. But if other 10% plus U.S. shareholders own another 60%, D is also a CFC, 72% total U.S. shareholder ownership. In the case, ABC treats D as a CFC, and its share of D's passive income falls under Subpart F, not the PFIC rules.
Okay, so if it's a CFC, what income gets taxed immediately under Subpart F?
The main target is called Foreign-Based Company Income, or FBCI. This is the bad mobile income. It includes passive stuff like dividends, interest, rents, royalties. But it also includes certain active income tied to related parties. For example, income from selling goods bought from a related party if the goods are made and sold for use outside the CFC's country, or income from services performed for a related party outside the CFC's country.
And the impact. If a CFC has this FBCI.
The U.S. shareholders, the 10% owners, are taxed currently on their pro rata share of that FBCI. No deferral. And importantly, no 100% DRD when that income is eventually distributed. It's a direct hit on those profit-shifting techniques.
Then the TCJA added another layer with GILTI, Global Intangible Low-Taxed Income.
Yes, GILTI came in with the TCJA effective 2018. It's essentially a new minimum tax on foreign earnings designed to reduce the incentive to move intangible assets and their associated profits to low-tax countries, even if the income isn't traditional Subpart F income.
So it's broader than Subpart F.
Much broader. It applies to a CFC's income that isn't Subpart F income or effectively connected U.S. income, subject to certain adjustments. The calculation is, well, it's complex. You start with the U.S. shareholder's share of the CFC's net tested income. Then you subtract a deemed return on the CFC's tangible assets. Specifically, it's 10% of the CFC's average adjusted basis in its depreciable tangible property. This is often called QBAI, Qualified Business Asset Investment, minus the CFC's net interest expense.
So income above a 10% return on tangible assets gets potentially hit by GILTI.
That's the basic idea. That excess is the GILTI inclusion amount for the U.S. shareholder. It's meant to capture the excess return, often associated with valuable intangible assets like patents or brand names that might have been shifted offshore.
But there's a break for corporations, a deduction.
Yes, a significant one. Corporate U.S. shareholders get a 50% deduction against their GILTI inclusion through 2025. They can also claim foreign tax credits, up to 80% of the foreign taxes paid or deemed paid on that GILTI income. This combo effectively cuts the U.S. tax rate on GILTI to 10.5%, half of the 21% corporate rate, before considering foreign tax credits. So it's a low tax, but definitely not a no tax. It ensures some U.S. tax is paid.
Can we walk through that Hughes Corp example to see the numbers?
Sure. Hughes Corp U.S. owns 15% of EKM Corp., a CFC. EKM's net income is $1,500,000. Its average tangible depreciable assets, QBAI, is $1,156,250. First, calculate the 10% return on QBAI. 10% of $1,056,220 is $115,625. EKM's GILTI-tested income is its net income minus that deemed return. $1,500,315,675 is $207,656. That's Hughes's GILTI inclusion.
And the deduction.
Since Hughes is a corporation, it gets the 50% GILTI deduction. 50% of $207,656 credits is $103,828. So its net taxable income from GILTI is $103,828 before considering any foreign tax credits. It shows how GILTI captures income but provides corporate relief.
Okay, another anti-deferral rule.
Earnings invested in U.S. property? What's that about? Sounds like bringing money back in directly.
Exactly. It stops CFCs from getting earnings back into the U.S. tax-free by disguising them as something other than dividends, like making loans to the U.S. parent or buying U.S. assets. If a CFC's investment in U.S. property increases during the year, its U.S. shareholders are taxed currently on their share of that increase, as if it were a dividend.
What counts as U.S. property?
It's pretty broad. Tangible property in the U.S., stock of a U.S. company, debt obligations of U.S. persons, like that loan to the parent, rights to use U.S. patents or copyrights in the U.S.
Let's use that Blue Corp example. A CFC loans $1 million to its U.S. parent halfway through the year.
Right. Blue Corp had 0 U.S. property before. In Q2, it loans $1. So quarter-end balances are $0, $1, $1, $1, $1. The average for the year is $0 plus $1 plus $1 plus $1, 4 times $750,000. That $750,000 is the increase in earnings invested in U.S. property. Blue Corp's U.S. shareholders get taxed on their share of that $750K immediately. It closes that loan loophole.
With all these rules forcing immediate taxation, Subpart F, GLTI, U.S. property, what happens when the CFC actually pays a dividend later from those earnings? Do you get taxed again?
Thankfully, no. That would be unfair. Earnings that have already been taxed by the U.S. under these anti-deferral rules are tracked as previously taxed income, or PTI. When PTI is eventually distributed as a dividend, it's generally received tax-free by the U.S. shareholders. This prevents double or even triple taxation and makes the system workable. It's a crucial ordering rule.
Let's talk about the transition tax. That was a one-off thing with the TCJA. A kind of cleanup.
Exactly. As the U.S. moved to the territorial system with the 100% DRD, Congress needed to deal with all those trillions in offshore earnings that had accumulated under the old deferral system but had never been taxed by the U.S. So they imposed a one-time mandatory deemed repatriation tax on these accumulated untaxed foreign earnings of CFCs, calculated as of the end of 2017. It was like a toll charge to enter the new system.
Who paid it?
The 10% U.S. shareholders of those CFCs. They had to include their share of these old earnings in their 2017 income. The tax rates were preferential, though, 15.5% on earnings held as cash or cash equivalents, and 8.0% on the rest, like earnings reinvested in factories.
That must have been a huge hit all at once.
It could have been. So they allowed taxpayers to elect to pay the tax in 8 installments over 8 years. It started small, 8% per year for 5 years, and then ramped up 15%, 20%, 25% in the last 3 years. A massive one-time event.
Okay, one more anti-abuse rule from TCJA. BEAT, base erosion and anti-abuse tax. Who does that target?
BEAT is aimed at large U.S. corporations, those with $500 million or more in average annual gross receipts that make significant deductible payments to related foreign affiliates.
Why target those payments?
Because things like royalties, interest, or management fees paid to foreign affiliates can erode the U.S. tax base by reducing the U.S. company's taxable income. BEAT acts as a minimum tax to counteract this. You calculate it on modified taxable income, which is basically regular taxable income before deducting these base-eroding payments to foreign-related parties. The tax rate started at 5% in 2018, went to 10% for 2019-2025, and is scheduled to hit 12.5% in 2026. It generally applies if these related party payments are more than 3%, 2% for certain financial groups, of the company's total deductions. The rules are complex, but the goal is clear. Stop excessive profit stripping out of the U.S. via deductions.
Wow, that's a lot of anti-abuse. But you mentioned the code also has incentives, right? Tax-saving methods, like FDII.
Yes, FDII, foreign-derived intangible income. This deduction was also created by the TCJA, and it's explicitly an incentive. It encourages U.S. companies to keep valuable intangible property patents, know-how in the U.S., and use it to generate export income.
How does it work? What income qualifies?
It applies to income from selling property to foreign persons for foreign use, providing services to persons outside the U.S., or selling property to related foreign parties if it's ultimately used outside the U.S. It's income derived from serving foreign markets. For tax years before 2026, U.S. corporations can deduct 37.5% of this FDII. This effectively lowers the tax rate on that export-related income, making it more attractive to generate that income from the U.S. It's a carrot to keep IP onshore.
Interesting. And there was another one, ICDISC. That sounded quite specialized for exporters.
The ICDISC, or Interest Charged Domestic International Sales Corporation, is a neat, long-standing tax-saving tool, particularly good for smaller, privately held U.S. exporters. It's basically a paper company that provides a tax break.
How does a paper company save tax?
Okay, here's the flow. 1. The U.S. exporting company pays a commission to its ICDISC. This commission is tax-deductible for the exporter, reducing its regular corporate income tax. 2. The ICDISC receives this commission income. But by law, the ICDISC itself is tax-exempt. It pays no corporate income tax. 3. Then the ICDISC distributes the commission money as dividends to its shareholders, who are usually the same owners as the exporter. These dividends are typically taxed at lower qualified dividend rates, not the higher ordinary income or corporate rates.
Ah, so you turn high-tax corporate income into lower-tax dividend income for the owners.
Exactly. It's tax arbitrage. You avoid the corporate level tax on the commission amount. There are limits on how much commission you can pay, generally the greater of 50% of export net income or 4% of export gross receipts. But it can be a very effective saving for eligible exporters.
So looking at FDII and ICDISC, it's clear the tax code isn't just about stopping bad behavior. It's also actively trying to encourage certain things, like keeping IP here and exporting U.S. goods.
Absolutely. It's a complex mix of sticks, like subpart F and beat, and carrots, like FDII and ICDSE, all trying to shape global business activity while protecting the U.S. tax base. So far, we've been deep in the corporate world. But international tax hits individuals and their cross-border investments, too. Let's shift to inbound transactions, the U.S. activities of foreign persons.
And foreign person means?
Non-resident alien individuals, foreign companies, partnerships, trusts, estates, basically anyone who isn't a U.S. person. The general rule is the U.S. taxes them on their U.S. source income.
And you said there are two main types of U.S. income for them, business and non-business.
Right, with very different tax treatments. If a foreign person is engaged in a U.S. trade or business, their income that's effectively connected with that business is taxed on a net basis. That means they calculate income minus related deductions, just like U.S. business, and pay tax at the regular graduated U.S. rates.
How do they operate that U.S. business? Branch or subsidiary?
They can choose. A foreign company could operate through a U.S. branch, filing Form 1120-F, or set up a U.S. subsidiary corporation, which files Form 1120 like any other U.S. corp. The choice depends on liability, regulatory factors, ease of getting profits out, etc.
Like that British Bunting example, U.S. branch in Austin.
Exactly. If the Austin branch has a $100 gross profit from U.S. sales and $40 in related costs, its U.S. taxable income is $60. That $60 is taxed at U.S. corporate rates because it's effectively connected income.
Okay, that's business income. What about non-business income, like investments, dividends, interest?
That's taxed very differently. Passive investment-type income like dividends, interest, certain rents and royalties, if it's not effectively connected to a U.S. business, is taxed on a gross basis. No deductions allowed. And it's subject to a flat 30% statutory withholding tax. The U.S. payer has to withhold this tax before sending the payment abroad.
30% sounds high. Can that be reduced?
Yes, significantly. This is where income tax treaties are crucial. Treaties often lower that 30% rate dramatically, sometimes to 15%, 10%, 5%, or even 0% for certain types of income like interest. It's a major tax-saving benefit for foreign investors provided by treaties.
And the U.S. ensures this tax gets collected through withholding. You mentioned FDAP and FATCA.
Correct. FDAP fixed, determinable, annual, or periodic income is the general withholding regime for these passive payments to foreign persons. The U.S. payer is responsible for withholding. FDA, the Foreign Account Tax Compliance Act, is different. It imposes a 30% withholding on payments to foreign financial institutions or other foreign entities if they don't comply with requirements to report information about their U.S. account holders to the IRS. It's really aimed at catching U.S. tax evaders using foreign accounts.
Now, here's something tricky. You said foreign individuals are usually only taxed on U.S. income, but they can become U.S. residents for tax purposes and get taxed on worldwide income. How does that happen?
It's a huge pitfall many people aren't aware of. Yes, a non-resident alien individual can accidentally become a U.S. resident for tax purposes, subjecting their entire global income to U.S. tax. There are two main ways this happens. The green card test is simple. If you have a U.S. green card, lawful permanent residency, you're a U.S. tax resident, period.
And the other test, the days counted test.
That's the substantial presence test. It's purely based on physical days spent in the U.S. You meet it if you're in the U.S. for at least 31 days in the current year. 80 your days over a 3-year period add up to at least 183, using a weighted formula. The formula counts all days in the current year by 1, 1/3 of the days in the first preceding year by 13, and 1/6 of the days in the second preceding year by 16.
Let's use Esther's example. UK citizen here, 122 days each of the last 3 years. For year 3 residents.
Okay, year 3, 122 days, 1 equals 122. Year 2. 122 days, 13 equals 40.67. Year 1. 122 days, 16 equals 20.33. Add them up. 122 plus 40.67 plus 20.33 equals 183 days exactly. Since she was here 31 days in year 3 and met the 183-day weighted total, boom, she's a U.S. resident for tax purposes for year 3.
Meaning she owes U.S. tax on her UK income, her French investments, everything.
Everything. Worldwide income. It's a massive, often unexpected consequence of spending too much time physically present in the U.S. People really need to track their days carefully.
Okay, related to residency and citizenship, what about leaving? Expatriation. Is there an exit tax?
There certainly is for wealthier individuals. The U.S. imposes a mark-to-market exit tax on covered expatriates. These are individuals who renounce U.S. citizenship or, for long-term residents, terminate their residency. You're a covered expatriate if you meet any one of 3 tests. A tax liability test, average income tax over $190K for the last 5 years, indexed. A net worth test, $2 million or more on expatriation date. Or a compliance test, didn't certify tax compliance for the last 5 years.
Mark to market. Meaning they pretend you sold everything.
Exactly. On the day before you expatriate, all your worldwide assets are treated as if they were sold at fair market value. Any gain is taxed in that final year. There is a significant exclusion amount, $821,000 for 2023, to shield smaller amounts. But for high net worth individuals, the tax hit can be enormous.
Like Kathleen with her $7 stock and low basis.
Yeah.
Renouncing citizenship.
Her net worth, $7, makes her a covered expatriate. Her deemed gain is $7 value, 250K basis, equals $6.75. Subtract the $821K exclusion for 2023. She faces tax on roughly $5.9 million of capital gain in her final U.S. tax year.
Ouch. So leaving the U.S. tax system isn't free if you're wealthy.
Definitely not. It comes with a potentially very steep price tag.
What about companies trying to leave, those corporate inversions?
Yes. The U.S. also has rules to discourage inversions, where a U.S. company effectively reincorporates under a foreign parent, usually in a low-tax country, to cut its U.S. tax bill. The IRS response depends on how much stock the former U.S. shareholders end up owning in the new foreign parent. If they own 80% or more, the new foreign parent is just treated as a U.S. corporation anyway for tax purposes. The inversion basically fails from a tax perspective.
Right.
If they own between 60% and 80%, the company is respected as foreign, but it gets penalized. It can't use certain tax benefits like NOLs or foreign tax credits to offset any gain recognized from the inversion transaction itself.
And the TCJA added more disincentives.
Yes, it denied benefits like the 100% DRD and lower dividend rates to shareholders of these surrogate foreign corporations created through inversions. The message is clear. The U.S. strongly discourages these tax-motivated corporate expatriations.
Throughout this whole discussion, tax treaties keep coming up. How important are they really?
Immensely important. They are formal bilateral agreements between the U.S. and about 60 other countries, and legally, they have the same weight as the Internal Revenue Code itself. They often override or modify the standard U.S. tax rules we've been discussing.
How so? What do they typically change?
They commonly reduce withholding tax rates on things like dividends, interest, and royalties, often way below that 30% default rate. They provide clearer rules for determining residency, for sourcing income, and for when a business activity creates a permanent establishment. They also establish those mutual agreement procedures for resolving disputes and preventing double taxation when the two countries' rules conflict. They provide certainty and stability for cross-border trade and investment. They're absolutely critical infrastructure for the global economy.
So we've covered a huge amount of ground today. It's really a journey into this complex world of international tax. We started with companies using transfer pricing to try and manage where profits land and how the IRS pushes back with the arm's length standard. Then we looked at the structure branch versus subsidiary and how crucial sourcing rules are. We unpacked the U.S. anti-deferral arsenal subpart F, GLTI, U.S. property rules designed to make sure foreign profits face some U.S. tax. But we also saw the legitimate tax saving side, foreign tax credits, the big 100% DRD, and incentives like FDII and ICDISC, and we touched on how these rules affect individuals crossing borders, residency traps, and the exit tax.
It really paints a picture of a system in constant flux, doesn't it? International tax isn't static. It's this ongoing negotiation between countries wanting revenue and the reality of global business. Companies will always look for legal ways to be tax efficient globally. That's just rational economic behavior. The real question is how tax laws, both in the U.S. and around the world, through efforts like the OECD's BEPS project, will continue to adapt. How do you balance attracting investment and allowing competitiveness with ensuring a fair contribution to national revenue, especially from highly mobile capital and intangible assets? It's a fundamental challenge for the 21st century economy.
That's a great point to end on. What does this constant evolution mean for global growth, for competition, and maybe even for you, the listener, interacting with this multinational world every day? Something to think about. Thank you for joining us on this deep dive into the fascinating and, yes, complex world of international tax issues. We hope you feel better equipped to understand the headlines and the strategies at play.